In today's real estate exam prep video, we're going to discuss what's called a 1031 Tax Deferred Exchange. I'm going to tell you everything you need to know for the real estate exam, and I'm going to do that right now. Hey everyone, my name is Vojchehoske and welcome to the Real Estate Classroom YouTube channel, just a place where we're trying to get you to pass your real estate exam the first try. So in today's real estate exam prep video, we're going to discuss what's called a 1031 Tax Deferred Exchange. Very common, particularly in the investment part of the real estate industry and commercial. So if you're a real estate professional that's going to be diving into the commercial realm, you're going to see these a whole lot more than you would in just the run-of-the-mill residential real estate sales market. However, you still need to know the basics, and you're going to learn more about, in more detail, about 1031 tax deferred exchanges when you actually get into the business. What I want to do today, because really this could be a 6-hour continuing ed class. There are so many aspects of this program, but you only need to know a couple of things for your real estate exam, and that's what I want you to know. So, okay, first thing right out of the chute, it is called a 1031 Tax Deferred Exchange, not a 1031 tax-free exchange. There is no such thing as tax-free. All right, we're deferring the taxes. I'm going to explain more about that in a minute. This comes from Section 1031 of the Internal Tax Code. That's why it's titled 1031 Exchanges. And it's important to understand that as of 2017, 1031s can only be used for real property. Prior to that, you could pretty much 1031 anything you wanted, personal or real property. But in 2017, there was some changes that were made that narrowed it down to real property. And the last thing here is just remember, 1031 tax deferred exchanges are used for investment property, not your primary residence. Okay, this is any kind of property, real property that's being used for investment purposes, which could include agriculture, commercial, industrial, and yes, even single family rentals, as long as it's being used as a rental property. So before we get into the details, you have to understand that this is all about the capital gain. This is about deferring the tax liability for what's called a capital gain. And I know most of you probably already know what this means, but I'm going to just do it just because I have to do it. There may be one or two people out there that's never heard of this. So let's look at your screen. There's an example of what I mean by, or how to calculate capital gain. So let's say that you had a small piece of farm ground or pasture land or a single family rental or maybe a small strip mall, whatever the case may be. It was an investment property and you sold it for $250,000. Now you have a cost basis of $150,000. That means the purchase price, how much did you pay for the property plus the improvements that you put into that? That gives us what's called a cost basis. So let's say between the purchase price and your improvements, you have a total of $150,000 into this property. So you sold it for $250,000, you have $150,000 into it. That means your capital gain or your profit is $100,000. Now, if you don't do some type of tax deferred exchange, that means Uncle Sam and your state and possibly your local governments, they're going to tax that. They're going to tax it. Now, here are some of the requirements you have to know for the real estate exam when we're talking about a tax deferred exchange. Number one, in order to defer your tax liability, now remember that $100,000, that profit is now subject to taxation. You must reinvest that $100,000 into another property of equal or greater value. Well, it has to be a piece of property that's also going to be used as an investment property. You can't use it for a personal residence. That's going to be, that's of equal or greater value. Now, here's the thing, the exchanger, that's you. So let's say you own this investment property and you sold it for $250,000. You're the exchanger. You close on this property. That transaction, that investment piece of property is closed. You now have 45 days to find and identify a replacement property. That means that property that you're going to buy and you're going to roll that $100,000 profit into it. You have 45 days to do it. I guarantee you that's one of the questions that's going to probably be on your real estate exam when they're asking about 1031s. They always ask about the days. 45 days to identify a replacement property and 180 days to close on that property that you've identified for the tax deferred exchange. So you have your investment property, you sell it. Now you have 45 days to identify a new investment property to invest that $100,000 in. All right, then you have 180 days total to close on that property. It's not 45 days plus 180 days. I know sometimes there are many questions on the licensing exam that will kind of use that to try to trick you. It's 180 days total to close on that replacement property. If you meet those requirements, and there are some other ones which we're not going to talk about here because you don't need to know for the real estate exam, then that $100,000 profit is not subject to taxation because you've deferred it into a new, more expensive, either equal or more expensive type property. That is the basics of the 1031 that you have to know for your real estate exam. Like I said, there are so many other things that you're going to have to know when you get into the profession, but you don't need them for the real estate exam. If you're going to continue studying, check out this video right here. If you have not subscribed to the channel, please do so. Click the little circle to my left. Comments and questions down below. Don't forget to share. See y'all in the next video.